Hello, this is Adam Hewson. I'm coming to you from the digital studios of Market Club. And what we're going to be examining today is the difference between fundamental trading and technical trading. Now, I'm going to take probably the best known fundamentalist, at least in my view, the most well known anyway, and that's Jim Cramer from Mad Money. I occasionally watch him. He's very, very entertaining. I'm not sure how great a trader he is, but certainly he's very entertaining, and he does have some pearls of wisdom every once in a while. But on the 8th of January, he basically came along and recommended 5 different stocks. Caterpillar is one of them. That's what we see on the screen right now. We're seeing the daily chart of Cat, Home Depot, Johnson & Johnson, Hewlett-Packard, and Verizon Communications. So the 5 recessionary proof stocks. Now, this is what I want to show you. He recommended the stocks right here on the January 8th. Okay, so this is where we closed January 8th. And as you can see with Caterpillar stock, we have gone straight down. And in fact, we're down. If you take from this level here to where we closed today, we're minus 25%. Now, I've seen Jim Cramer talk about the marketplace, and he talks about money management, but he never seems to put in the magic word stops. When you're wrong in a market, you need to have the ability to exit that market and preserve your capital. Now look, how much do we expect this market to go up? It's got to go up 50% now just to get even, and you're back to square one. I'm not sure that's going to happen. Today's close was incredibly negative for Caterpillar. They're laying off people. Business isn't so good. Maybe it'll turn around, but why not buy it when it turns around? That's the key. Why not buy it when it turns around as opposed to the other great sin in trading, in my opinion, is trying to pick a bottom. It just doesn't work. I mean, the odds are against you, and this is a classic example of the odds being against you. So Mr. Cramer said to buy here. I want to see what our trade triangles had to say. So I'm going to take everything off the screen. It's simple to do. And I'm going to put our trade triangles in. I'm going to start with our weekly triangles. Our weekly triangles actually came in a few days later, so this is on the 12th of January on our weekly charts, and said to sell. Mr. Cramer was buying, we were selling. Where would you rather be? We're short from 40.65 right here, and the market's at 32.66. We have a nice return. Would you rather be long at 44.08 and have a 25% loss? I know where I would like to be. I'd like to be with this. And the question becomes, if you recommended buying it here, for example, and you get a sell signal here, but you don't take advantage of that sell signal, now from 58 you can go down to, let's say, 38, another huge potential loss. You've got to learn to use stops effectively to protect your capital. That's what I'm looking at. So let's take this off the screen. I'm going to show you our whole trade triangle setup and how you analyze markets and how you make it work so you make money in the marketplace scientifically. So I'm going to take this off the screen. I'm going to go up to our monthly charts, because everything in stocks, everything emanates from the monthly. So here it is, July 1st, 72.56. This is 1, 2, 3, 4, 5, 6, 7 months ago. So 7 months ago, on July 1st, we had a sell signal. That's a sell signal to go short at 72.56. Okay, that's the number. There's the triangle right here, so you'll see everything right here. And you're looking, that's an indication that this market's going to go down in value. So that was our first signal, 72.56, and it stayed intact. You can see for the last 7 months, there's nothing to say it's not going to go further. This formation, by the way, is a negative formation indicating lower levels. So we use I'll take everything off the screen, we use the monthly triangles to determine the trend. Okay, so once we have a monthly signal, we consider that the major trend for the market, and we want to be in that position starting from this date and this price. Okay, so it's 72.56. We then go to our weekly charts. I'll give you a couple of examples. You're short from, this is the weekly charts, this is where you do your timing, from 60.04. Market goes down. We cover this position at 41.18. So we've taken a very nice profit on this stock. Almost 19, let's call it $18 profit after commissions, just to be safe. Okay? We're out of the market. From here to here, we're out. Okay? So we don't have a long position. We don't have a short position. We're simply out on the sidelines for 1, 2, 3, 4, 5, 6 weeks. So it's 6 weeks sidelines. So there you have it. We had sell signal on the 12th of January at 40.65. Mr. Cramer was buying at 44.08 on the 8th. So we're short. We're sticking to our guns. The trend is your friend. And when you're learning to trade with our approach, our trade triangle approach, you learn discipline, you learn entry points, and you learn how to filter your trades like here, so you're out of the market when it's not doing anything where you can make money. Hey, this is Adam Hewison. Remember, there are two ways to trade the market. There's the fundamental way, then there's the technical way. And people are going to argue both ways, but the way I like to look at the market is based on our trade triangle technology and on a technical level. The technicals sum up all the fundamentals in price action. The market closed at 32.66. We're doing this on the 26th of January because that's where everybody thought the market was worth that day and that time. It's Adam Hewison. Thanks for stopping by. I'll see you on the web.